Well, folks, the market is about to be bad, okay? I mean, absolutely bad. So 4 videos to react to here. I'll talk about those in just a moment, but basically it's going to be an ugly one out there. Over the next 24 to 48 hours in the market, okay, Google McDougal's down about 7%, massive move down. And Google, it was a $1.3 trillion market cap. Microsoft is getting hit very hard now. This one was only down 1-2% at first after hours. Now it's down approaching close to 7% as well. And I mean, we're talking about pretty much the second biggest market cap company in the world at a $1.8 trillion market cap. So 6.5% there is bad. It's going to be awful for the NASDAQ, okay? So first video we're going to react to is the raw numbers out of Google and kind of my opinion on that, okay? Then I want to react to this video from Google and Microsoft shareholder and kind of give my 2 cents. Going to talk about Chipotle. Actually see an interesting opportunity in Chipotle and not actually from the long side. So we'll watch that. I want to give my 2 cents on that. And then we're going to watch Mr. Jeremy Siegel give his opinion, not Jeremy Lefebvre, Jeremy Siegel give his opinion on the Fed will pivot soon after tremendous progress on inflation. So interesting, okay? That's the way I'll leave that as of right now. So yeah, 4 videos to react to here. Thank you everybody for joining me. As always, it's going to be a very busy video here today. I think we're at 17,400 subscribers now, or maybe 17,500 subscribers. So thank you everybody that is here. The channel is strong like Donkey Kong, okay? Let's go ahead and jump into this. By the way, if you want to join my private stock group, private Discord chat, everything like that, check out pinned comment down there.
I'm looking at the moment. Let me break them down for you. Q3 revenue coming in at $69.09 billion, 70.6 was expected. And that is
right off the bat, I mean, to miss by $1.5 billion for a company like Google McDougal, you can't do that. You can't do that, and especially in this sort of market. You can't do that in any market, right? But especially in this market, that adds more worries on top of more worries when you come in with a $1.5 billion miss for revenue.
Slowest revenue growth we've seen from Google since about 2013. Also coming up short on the earnings per share, coming in at $1.06, $1.25 was expected. Google.
That's a disastrous miss on EPS there, and that's the issue. If you're talking about issue with countless of these big, huge companies, is we're seeing them coming with these horrible earnings per share numbers. Just bad, right? That's a huge miss. That's even scarier than the revenue miss. The revenue miss was bad, being down, a miss of $1.5 billion. This is worse. This is worse. Let me be quite clear about that, okay? And here's the scariest part of that. If you're wondering, why is that such a big deal? The reason that's such a big deal is if these companies continue to miss like that, Wall Street's going to start to expect that 2023 is going to be a pretty big down year for earnings per share. Now, obviously, we'll see how all that plays out, but that's the way Wall Street will start running with this thing, because they're like, look at Google. They missed massively on earnings per share. This company missed massively. This company. So that's where you start to get in. The problem is these stocks are the stocks that run the stock market, right? They're the biggest market caps. So then Wall Street starts saying, we're going to have a down earnings year next year, so prep for, 10% less EPS than we had in 2022 or something like that, right? So that's kind of the trouble. Only good news is year over year, it does make comps easier when you come in with a miss like that.
Another area that we were watching very closely, also a little light here, $6.87 billion versus 6.09. I'm sorry, that is a small beat. YouTube, though, is another miss here, $7.07 billion versus $7.42 billion. So a little bit of upside.
Interesting, cloud, very slight beat. And interesting, YouTube actually missed numbers. If I had to guess, what I believe it is when it comes to YouTube, obviously 2020 and 2021 were just amazing years for YouTube, the platform, right? Because so many people had so much time on their hands. People got to work from home. What do people like to do a lot more when they work from home rather than work in an actual office? Oh, watch YouTube videos simultaneously, right? And maybe you're working, but then you got YouTube on over here and you're kind of listening to that and watching this over here. All that's gone away now at this point in time, right? And I can just tell you from the finance niche perspective, right? It's not, the viewer counts that folks got. That was the peak for YouTube finance probably ever, to be quite frank, was 2020 in terms of how many people were watching, because so many people were at home, so many people cared, so many people were paying attention and things like that, right? And that's tough, right? And then if you're talking about YouTube from the entertainment perspective, that's cool and that's good, right? But there's also there's a lot of things battling for that. Instagram's battling for that now because they're taking Instagram Reels extremely serious, and they're having a lot of success there from what I see. TikTok's a major competitor from their side, right? So you have that. Obviously, Netflix continues to be a competitor, right? And so all these things add up to, major competition and just less time people have, right? And if somebody goes and spends 3 hours at a concert now, right? Shoot, that's 3 hours they can't spend watching YouTube that they might have spent in 2021 or 2020, right? If somebody goes to a football game and that's 4 hours out of their day, right? Well, shoot, no, that's 4 hours less they might have been watching YouTube before. So these are very important factors to remember.
Cloud, but of course this makes up a very small percentage still of the business. Ads are where it's at and coming up short in terms of revenue, earnings per share, and in particular YouTube. I believe that's the slowest growth that we've seen in some time as well, about 3%. Scott, back to you.
Tell you what, I know we're going to hear from you again, Dee, but what jumps out to me, I think more than anything else, is when I was leading up to this, I suggested that Alphabet was expected to post the slowest revenue growth in some 2 years. What I think I heard you say was that they actually posted the slowest revenue growth since 2013. Did I hear that right?
Let me check. I believe so. Yep, about 8% since the weakest expansion for any quarter since 2013. That's right. And YouTube, that growth has slowed to about 3%, Scott. So, yeah, that is weakest we've seen in a long time.
3% growth in YouTube. Wow. I mean, the problem when you get down those single-digit numbers, especially low single-digit, which 3% revenue growth is very low, what people start to run with, and I don't think YouTube growth is going to go negative, my personal opinion. But what's very important to understand about that is countless folks on Wall Street are going to start saying YouTube growth is going to go negative because look, it was at this number, it was at this number, now it's at only 3%. What's next quarter? 1%? What's the next quarter? Negative 1%? What's the next quarter? Negative 5%? Because, that's the way people like to run these projections is like lower and lower growth to all of a sudden shrinking, right? Like I said, I don't see that happening, but that's the narrative Wall Street can start to run with. And I'm sure the whole data situation, right, on the iOS side is I'm sure it's hurting YouTube as it's hurt Meta and everybody that's in the advertising space. That has helped Apple, but that will be the death of Apple long term because now these companies are even more incentivized than ever to take out Apple after, kind of what they've done to these other companies.
Yeah. So, Dee, thank you. As again, I said, we'll hear from you in a moment. I appreciate that. All right.
Google and Meta and those sorts of companies, they're not going to forget what Apple's pulled in this whole situation. Believe me, they won't forget.
Alphabet first.
Alphabet's more concerning. Clearly, when you see the deceleration in revenue, again, second consecutive quarter for YouTube, not enough for the cloud business. And let's remember, the cloud business really isn't profitable. It's rated third behind Microsoft and Amazon. So if I have more concern, it's with Alphabet. Let's keep in mind, though, to temper that pessimism that I'm sharing, strong buyback in place for Alphabet. So that buffers the downside here. But of the two, more concerning with the economic exposure of this company.
Yeah, great point by him right there, okay? Did you hear the point you just made? He's basically saying that, the cloud business is really like the third most important business for Google, right? It's Google, then it's YouTube, then it's a cloud business. And so the one segment that's slightly beat was the cloud business, but that's the business not a lot of people care about. They want to see search results, which is the Google's traditional business, right? And they want to see YouTube. And so when those come in and disappoint in a big way, that's what moves the stock, right? And that's why we see the stock down quite considerably. It's down, 6.66% now at this point in time. I'm still shocked about the move down on Microsoft because you saw what Microsoft was down in that video when the earnings first came out. It was like a 1% to 2% mover, and just as time progressed and the conference call started, now 6.6%. All right, let's go ahead and react to this one up next, and we'll get to Chipotle, and then we'll get to Fed pivot Jeremy Siegel. Okay, juicy stuff.
Advisors, Malcolm Etheridge of CIC Wealth. As I said, both own Microsoft and Alphabet. But Brenda, I'll go to you first. Let's take Alphabet because that's the bigger mover right now, down some 6%. A miss and a miss.
Was the bigger mover?
Yeah, well, I think we have to take this into context here and look at many of these large cap companies were huge beneficiaries of the environment they were in over the last couple of years. So I think it's natural in many ways that they're seeing trends slow and normalize. But when it comes to Alphabet, I think, we've heard from many companies that digital ads as spend has been lower. And so I think the business has just matured so much that no one is really immune at this point, including Alphabet. So it's not terribly surprising, but, this is what we've all been thinking was likely to come, but expecting that search would likely be a little bit more immune than some other areas within digital ad spending. But nevertheless, here we are. So we need to hear more on the conference call, certainly, to get more details about exactly what the company is experiencing. But I think we have to take it from a big picture perspective and recognize that, no one's really immune in this market if there is a digital slowdown in digital ad spend.
Yep, that's for sure. Malcolm, what's your take?
So, True. Let's take a quick peek at what analyst estimates are here for Google McDougall for current year, 11.7%. There's going to be real concerns on if that's actually what they're going to grow now at this point. Very high probability they're going to grow single-digit percentage points now at this point in time. And that leads you into 23, where analysts are going to start looking and like, is this no longer a double-digit growth story? Is this now a single? And there's a big mental, I think this is important for everybody watching this to understand this, okay? There's a very big mental hurdle between a company that you're buying into or you own that is growing revenue at a double-digit percentage clip versus single-digit percentage clip. And like from just a mental perspective, I mean, it's funny how it works. If there's a company that's growing at 12% versus 8%, even though it's only 4 percentage points, in investors' heads, it's such a difference. And in fund managers' heads, it's such a huge difference because one's a double-digit percentage, or I own a stock that's a single-digit percentage gainer, right? Which, when you start talking about single-digit percentage growth, you're 100% now just into a value stock category. That's what you get thrown into. When you are a double-digit percentage grower as far as revenue goes, and that is expected, you get funneled into growth stocks. And so the way your company is valued is similar to a growth stock. But if you look at the way Google's starting to be valued, this stock is starting to be valued like it's a value stock, right? And it's starting to be valued like it's a single-digit percentage grower moving forward. Now, my personal opinion on this is Google will get back to double-digit percentage growth in likely 23 and 24 and still be a growth company. But it's not going to be, I don't see Google anytime soon, if ever again, being the sort of growth company it once was. Because Google, you used to be able to get like 20% revenue growth a year. And if you look at Google, for a number of years, they used to be 20% plus growth almost every single year in and year out. That's what you just got to expect it. Google's going to grow 20%. Boom, boom, boom. And now I think analysts could bring down their projections for 23 to 9% or 7% growth. It's a whole different ball game there, right? Whole different ball game. Some might even take revenue growth. To be quite honest, they might take it down to like 5% in Google McDougall. That's definitely a realistic possibility there, okay? All right, let's see what this gentleman
on the Google Alphabet side, I very much expected them to come in and report another quarter of slowing sales growth since
something clearly happened in Microsoft's conference calls, because look at the way that baby tanked. I mean, the numbers were long out, and like I said, it was down 0.5%, 1%, maybe 2%. Something happened on that CC that went south. I'm going to have to listen to that baby tonight.
Didn't know it was back to 2013. That was news to me, but I knew at least for the last 6 quarters they had been talking declining revenue because of their ad sales, both in the paid search and on the YouTube side. And so I expected to hear issues surrounding the strong dollar coupled with slowing revenues, and that was going to bring down the stock pretty much in line with what ultimately happened. So I'm very much not shocked that Google is having the quarter that they're having. And
so something he just pointed out there, I think is very important, that gentleman there, is he pointed out that the dollar obviously hurt Google's earnings, right? And that's hurting a ton of these big multinational companies that do business all over the globe, right? At some point in time, we don't know if this is 2023 or it's 2024, but at some point in time, the dollar is going to go from working against these companies in terms of their numbers to actually working for them and going from a headwind against the companies to a tailwind. Like I said, it's a hard prediction to make whether it's going to be 2023 or 2024, but I can promise you it will be one of those years. The dollar is not going to continue this crazy upward trajectory just going to the moon for the next several years. That ain't happening. And so at some point in time, the dollar will break. It's just a question is it 23 or is it 24? And that will be a big, huge help for a ton of companies out there in regards to their numbers. Okay, next up, Chipotle. And I have a pretty strong opinion on Chipotle. Pretty strong.
Earnings per share coming in at $9.51 on an adjusted basis. That does exclude a number of items, including a $3.5 million charge related to an employee separation. Analysts were looking for $9.21. Revenue essentially in line at $2.22 billion. Same-store sales increasing 7.6%, which was slightly ahead of estimates. Now, in terms of guidance, the company sees fourth quarter same-store sales growth in the mid to high single digits. CEO Brian Nichols saying that consumer discretionary spending is tightening. So we'll be looking for more color on if and how that's impacting Chipotle's numbers. During the call last quarter, the company said it hadn't seen a slowdown from its higher income consumers. Scott?
All right, that's Pippa Stevens with the latest on CMG. Consumer spending tightening for a company that's had the ability to raise its prices repeatedly, and now you wonder how much pricing power they actually have left.
Raised prices 4% in August. You've got some lower costs as it relates to food, but I think you're right here. A lot of feel good is in this stock. This stock trades at such a premium valuation relative to its peers. So it needed to have a blockbuster quarter. Maybe the conference call will provide some form of a catalyst here for the stock. I'm going to stay in the stock. There's nothing here that concerns me, but let's understand the expectation here, and let's hear from Brian Nichols exactly what the state of the consumer is.
Yeah, so my personal opinion on Chipotle, I actually think it's a shorting opportunity in 2023. I really do. I mean, if we take a peek at this stock, it trades at incredible valuation. I mean, first off, the whole company's valued at about $44 billion right now, which is just wacky. As far as PE goes, 58 PE as of right now. Depending upon what you think the company's going to earn in 2023, it's trading at, roughly between a 35 and 45, depending upon kind of what your numbers are for Chipotle. So the stock's incredibly richly valued. And in a what's going to be a very, very tight consumer environment for the next year, certainly, right? I think there's a real possibility of big pull down in Chipotle. All it's going to take is one really troubling quarter where this company reports comp store sales that are not very exciting, which I think is definitely coming in the next couple quarters, and that baby is going to tank. And when that baby tanks, it's not going to be like down 5% or 7%. It's going to be down like 20%, and then like 40%. In like 3 weeks, okay? And like it'll go down that rapidly. I've seen countless times before Chipotle is an extremely volatile stock on the downside. And so I think that's definitely a realistic possibility in 23. So I'm tempted to short the stock in 23 or maybe do put options or something like that. Knowing me, I probably won't do it. Because I hate betting against companies. I really do, even though I think Chipotle is very overvalued, and I think the numbers are going to be extremely disappointing coming in from that company. Not because of necessarily anything they're doing wrong. It's just they've had to keep increasing prices rapidly. They have costs that keep going up for their workforce, and ultimately, I think the consumer environment is not going to be great to sell $13 burritos, in my opinion, over this next year. Okay, so that is my opinion on that one. Okay, let's talk about a little Fed pivot talk. Okay, a little Fed pivot. This is big comments here, big comments.
Bullish on things, and by the way, the equity market, with the exception of this morning a little bit, has been bullish on things. How much of that is a function of a view that the Federal Reserve is going to stop moving higher? Or is it a view that they may go higher and then ultimately be forced a year from now, let's say 9 months from now, to actually go lower later?
Yeah, I think there's going to be a pivot soon. And I don't mean that means they're not going to increase. I think it's going to be 75 basis points next week. But I think they're going to acknowledge that there has been a tremendous amount of progress made on inflation. And I want to reiterate the very important housing market distortion.
First off, let me just take that tremendous amount of progress made on inflation. So you could say they've made definitely some sort of progress on inflation. And once again, is that really the Fed doing that? Is it because they've raised interest rates that certain prices of certain things have gone down? I'm not so convinced of that, okay? Personally, I think naturally that was going to happen regardless if the Fed raised interest rates or not, okay? But I think the other important thing to remember in regards to the Fed and this whole situation is inflation is still incredibly high as of the recent numbers we've gotten over the past few months, right? So although you could say there's been progress made, yes, but the numbers are still incredibly high. So we do have to keep that in mind. There's a big difference between just like making some progress and like it's bad, right? It's no different than you could say, I made tremendous progress in school. I didn't get an F this quarter or this latest semester or whatever. I got a D in class. And it's like, oh, cool. Yeah, you made progress. Instead of getting an F, you got a D. But it's still a D, okay? So it's still not like it's good.
In the index, in fact, in less than 10 minutes, we're going to get the very well-known and well-respected Case-Shiller monthly index. I predict it's going to show a decline, maybe about 0.8%. We're also going to get a Federal Housing Administration index, which I predict will be a decline. Now, if you remember...
It's interesting. The futures were all negative this morning, but let's just take a peek. And how'd the market do? Oh, my word. It was green. It was so green today. Man, remember when we used to have green days like that all the time? It was like the regular thing. Now it's like we get one of those type of green days like once a month maybe. It's like, come on, man.
Panic. The capital markets and the stock market 2 weeks ago was that core rate. Well, that core rate was pushed up by an increase of 0.7 in the housing sector. And as I pointed out, with the Bureau of Labor Statistics lags so dramatically, them putting that in, that we're going to see the real index decline in 10 minutes, and there's still a inflation in the core rate.
So, I think... But yes. Jeremy, I'm just trying to understand. So short term, you think they raise 75 basis points. Before the end of the year, another 75?
I don't know why people say Jeremy. It's Jeremy, okay? Jeremy, Jeremy. It's not Jeremy. It's Jeremy, okay? And just need, man. People do that all the time.
I hope not. I don't think it's needed. I think, 75 and 50 and wait. I mean, I don't even think that's needed, but I think that the market is more than hoping for what exactly it is, but a statement by the Fed that they see progress. Right. And at some point can afford to pause and see if that progress really makes it. That's what the market is looking for. What scares the market the most is the Fed is going to stay this tight through 2023, which I absolutely think would be really a disaster for the economy.
But let's say they even lighten up and we get into a situation where there's actual real unemployment and we start to actually see that move. I would think if at the rate we're going, you'd start to see that by February or March, maybe, I don't know. And then maybe they reverse course. I don't know, but there's a Larry Summers view of the world, and maybe you think he's right and wrong, that we're going to get into a period of stagnation. And then what?
Well, I respect it, but I disagree with Larry that we have to be as high as he thinks we have to get, because I really think that tremendous progress is already.
How high are we talking? We talking like planet high?
Made against inflation, and we're way on the downside, even though the statistics won't show it for quite a while. So I think that the Fed is, I wouldn't be surprised to see a 2% Fed funds rate by the end of 2023 as we see the economy. So what's important?
You wouldn't be surprised to see 2% Fed funds rate by the end of 23. Big comment there.
Patient. We've only had 6 months of tightening. Started in March. And all of a sudden, because core rates are not going down, people are saying, the Fed's not working. It has to keep on hiking. There are long and variable lags in it. You look at the explosion money started in 2020, and it didn't. We wouldn't get a lot of inflation until 2021.
Professor, I don't want to misstate the Larry Summers position. I agree that he wants higher rates. There's no question about that. But then he talks longer term about a period of effectively secular stagnation. If that's the case, the question is the market, a great value buy? I think the way you would argue it is, but that would require, I think, to see serious growth at some point.
Well, I think there's a chance the Fed can save that stagflation and a serious recession if they acknowledge now that progress been made. I don't think that we're going to have. I think inflation's coming down. Don't forget, stagflation is high inflation with very slow growth. Now, we really had slow growth. This year's GDP is very, very low, and we're having coming down inflation. So I don't think 2023 is going to be marked by the stagflation that Larry fears.
Yeah, so...
Shepard.
Hey, Shepard. Hey, Shepard, you just popped out of there, huh? Okay, so in all seriousness, I think that's a huge fear for the market in regards to what Larry Summers specifically spoke about, which is a period of stagflation going on or just kind of stagnation in the economy, right? Because that would mean a stock market that doesn't do much for, let's say, the next 2 years, right? Which most people don't like a stock market that does nothing for 2 years. Now, let's say that the stock market goes nowhere for the next 2 years, right? Let's say literally it's 2 years in the future. The NASDAQ's the same as it is today. S&P 500, Dow's the same as it is today, okay? Russell's the same as it is today. You got to understand there's still going to be massive winners and losers, even in a stagnation stock market. And that's where it does become important to be a stock picker. And I know stock pickers have gotten the worst thrown at them for the past year, right? And everybody said everything except stock picking, right? Because so many stocks have gone down so much, right? Keep in mind the QQQ has also gone down massively. S&P 500 has definitely been hit. So those haven't necessarily been the best, right? The Russell index has been hit. So even the index have been hit pretty hard. But in terms of when you talk about, investors definitely got spoiled for a while because, index funds, it's just like throw your money in an index fund, you get your automatically 8% a year or whatever it is, right? Very easy. No thought process goes into that, right? But what if the indexes don't go up? Well, that's where stock picking can become even more important, right? It's not just about, for stock picking, for me, it's about a few things, right? One, I love the fun of it. For me, it's fun, the competition, looking into companies, like the conference calls, all that stuff is fun, right? Two is for those opportunities where you get ridiculous gains, right? That stock that goes up 300%, 500%, 1,000%, right? That, to me, is a lot of fun trying to find that company, invest that company, and risk that capital for that type of return, right? And the other part is, for situations where the index, you can't always count the index as just going up and up and up for gains, right? And we, like I said, as a society, we've gotten very, very spoiled with just the index is going up year after year after year. And you got to understand, it's very possible that what if the stock market doesn't go anywhere for a 5-year span? What if it's a 10-year span? I can tell you in there, there's going to be countless stocks that do absolutely awful. There's going to be countless stocks that do absolutely tremendous. And the indexes might not have gone anywhere in that situation, right? And so that's why I think stock picking is extremely important to build out a basket of 10 to 15 stocks in a portfolio. That's my personal opinion on that, okay? So I hope you guys enjoyed this video as always. Like I said, I think we got, 17,400, 17,500 subscribers. I appreciate each and every one of you that are subscribed to the channel. Much love as always. Hello, Shepard, and have a great day.